The year is 2024. A young couple stands outside a modest three-bedroom home in a quiet American suburb. 10 years earlier, this house would have been considered comfortably middle class. Today, it sells for nearly 3 times its previous value. The couple has done everything conventional financial wisdom told them to do. They earned college degrees, they saved diligently, they avoided unnecessary debt. They built strong credit scores. Yet, after losing another bidding war to an all-cash buyer, they drive home wondering whether homeownership has become a privilege. Meanwhile, only a few miles away, another homeowner watches the same housing market with a completely different emotion. Every month, the estimated value of their property climbs higher. Their mortgage payment remains fixed, locked in years ago at historically low interest rates. Their net worth appears to grow while they sleep. They have become wealthier without producing anything new. 2 families, 1 housing market, 2 opposite realities. How can the same economic system reward one household while shutting another out? Why do home prices continue climbing even during recessions and layoffs? The common explanation is simple. People say there aren't enough houses. Others blame investors, zoning laws, or the Federal Reserve. Yet none explains why housing has transformed from shelter into one of the world's most powerful financial assets. Understanding why housing prices keep rising means understanding the invisible architecture beneath the American economy. A house is no longer just a place to live. For most of human history, buying a home was extraordinarily difficult. In the 19th century, mortgages looked nothing like they do today. Banks rarely lent money for long periods. A borrower often needed to provide half the home's value up front. The remaining balance came due in 5 years. Then came the Great Depression. Between 1929 and 1933, the American financial system experienced a massive collapse. Thousands of banks failed. Nearly half of all urban mortgages were technically in default. Policymakers realized if ordinary families couldn't finance homes safely, economic stability remained vulnerable. The solution reshaped American finance. The federal government created the Federal Housing Administration and Fannie Mae to support mortgage lending. Think of a neighborhood bakery. If it sells 1 loaf daily, growth is slow, but if it sells future bread subscriptions to investors, cash flows immediately. Mortgage markets evolved the same way. Banks received fresh capital to make even more loans. More lending meant more buyers, and greater demand pushed prices up. The 30-year fixed-rate mortgage was revolutionary. Instead of demanding enormous upfront payments, banks allowed households to spread payments across decades. Housing prices are often determined less by what people earn than by what monthly payments they can manage. This changes everything. Suppose mortgage rates fall from 8% to 3%. Millions of families suddenly qualify for larger loans and enter the market simultaneously. The houses did not become larger. The buyers became financially stronger through cheaper borrowing. Affordability often declines because prices adjust upward. Housing transforms from consumption into investment. People no longer buy only because they need shelter. They buy because they expect appreciation. The promise appears limitless. Home ownership becomes central to the American dream. Tax policy begins rewarding ownership. Everyone appears aligned. Then one small shift changes the equation. Land. America does not run out of land. It runs out of desirable land near jobs and schools. Zoning quietly determines what may exist on land. If regulations prohibit denser construction, supply remains fixed regardless of demand. Every expansion of mortgage credit increases what buyers can spend. Banks understand that every new mortgage generates decades of interest payments. What began as a system to stabilize home ownership evolved into a global financial network built on one belief. Nationwide housing prices rarely fall. The assumption feels reasonable. Local housing markets had crashed before, but a synchronized nationwide collapse in home prices seemed almost unimaginable. During the 1990s and early 2000s, interest rates declined, and financial institutions became sophisticated at packaging mortgages into securities. American housing appeared stable. To understand what happened next, imagine 4 boxes: a family buying a home, a local bank, a large investment bank, and global institutional investors. Instead of holding the mortgage for decades, the bank now sells it. The investment bank bundles thousands of mortgages into mortgage-backed securities. This innovation created a paradox. When lenders no longer keep loans, quality becomes less important than quantity. The machine needed constant fuel, new borrowers. Then came the catalyst. Interest rates rose and millions of adjustable rate mortgages reset. Defaults increased and suddenly housing prices stopped climbing. One decline echoed throughout the system. Trust disappeared and credit markets froze. The housing crisis transformed into a global financial crisis by 2008. After the crisis, the U.S. underbuilt housing for years. Meanwhile, demand recovered, and the Federal Reserve maintained historically low interest rates. The COVID-19 pandemic altered where Americans lived. Remote work increased demand for larger homes, while inventory remained limited. Prices accelerated at extraordinary speeds. Today, we see the lock-in effect. Homeowners with low rates won't sell to buy at higher rates. supply contracts, keeping prices resilient despite high interest. To analyze the future, look at four things: supply, credit, demographics, and incentives. Understanding these explains behavior more effectively than any ideology. Housing prices rise because of limited land, expandable credit, and human demand. A house is not just a product, it's land, leverage, and expectation. Real financial literacy is recognizing the architecture beneath the price tag. Once you see the plumbing, the entire housing market finally begins to make sense.